Welcome back to the deep dive. Today, you gave us the sources, and we are diving into a really intriguing local market.
Oh, absolutely. We're looking at Farmington, Missouri, ZIP code 63640.
And the data we have is, well, it's a mountain of it. Public records, MLS activity, all updated right through November 2025.
And if there's one number, just one, that kind of defines the urgency here, it's got to be the median sold price for November.
Oh, yeah.
It shot up to a staggering $340,000.
That's the headline that just stops you in your tracks. I mean, we are not talking about some slow, steady appreciation here.
No.
That $340,000 figure, that's almost a 50% jump, a colossal 47.83% increase from October.
Right, from $230,000, that's an extra $110,000 on the median home in just 30 days.
Mm-hmm.
It's just wild.
Exactly. So our mission today has to be figuring that out. Is this 340 number, the new reality for Farmington?
Or was November just an extreme anomaly? Like maybe a bunch of high-end homes all closed at the same time.
Right. We need to find the clues in the data, look at inventory, competition, and see if we can solve the mystery of that spike.
Okay, so let's start with the basics. Market velocity, market health. How competitive is it really underneath that huge price tag?
Let's start with inventory, the rarity factor, as we call it.
The rarity factor. And yeah, it confirms what you'd expect. This market is fundamentally tight. Months of inventory is sitting at just 2.33.
And for you listening, that number is so critical. It basically tells us how long it would take to sell every single home on the market right now.
If nothing new was listed.
Right. And 2 1/3 months is just extremely low. A balanced market is more like 5 or 6 months. So this 2.33, it tells us Farmington is firmly a seller's market. No question.
But here's what's interesting. While it's tight, inventory did actually go up last month.
Oh, really?
Yeah, we saw it rise by 14.02% month over month. So sellers are responding, they see the demand.
But it's not nearly enough to cool things down.
It's not even close. It's like a drop of water on a hot skillet.
So it's a little pressure relief, but the pot is still boiling over.
Yeah.
Okay, so what about the negotiation factor? How much power do buyers actually have?
Well, this is where the desperation really shows up. The sold to list price percentage is 99.2%.
99.2. So buyers are paying almost exactly what sellers are asking for.
On average, they're only getting, 0.8% off the list price?
And to put that into perspective for everyone, on a $300,000 home, that's just $2,400.
Yeah, that's barely anything. Maybe cover some closing costs.
You're not really negotiating the price down at all, and that competition is actually getting worse for buyers, right?
It is. That 99.2% is up 1.94% from October. So buyers are in a weaker position now than they were just last month.
Okay, so far, every single clue points to an extremely hot market. Low inventory, no room to negotiate.
But, and this is a big but, this is where the data starts to contradict itself a little. Let's talk about the patience factor, or time on market.
Okay.
The median days in RPR is 50. 5. 0.
Wait, 50 days? How is that possible? If the market is so hot that buyers are paying full price, why is the average house sitting for almost 2 months?
That's the question. It doesn't seem to track, does it?
Not at all.
And just to clarify for everyone, RPR is Realtors Property Resources, a big industry database. But that 50-day median is not fast. And what's more, it increased by a huge 28.21% month over month.
Wow. Okay, that is the definition of a counter trend. Everything's pointing up, 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 but houses are sitting long.
It's significantly longer.
So what's the explanation? Is this a sign that maybe the market is secretly softening?
I don't think it's softening necessarily. I think it might reflect some seller optimism or maybe over-optimism.
So they see the headlines and price their homes way too high.
Exactly. The market heats up, sellers get greedy, they overshoot the mark, and then buyers push back. So the properties just sit there.
So that 50-day average might be skewed by overpriced homes, not by a lack of buyers.
It could be. Or it could be that a few really unique high-priced homes that just naturally take longer to sell are dragging that average up.
Which brings us right back to that $340,000 price spike.
It does. We have to figure out if that price is real or if it's just volatility.
Right. Let's really get into this price puzzle.
Okay, so that November median sold price of $340,000. We already said it was a 47.83% spike from October. That level of growth month over month is just It's not sustainable.
Not unless something fundamentally changes in the area, right? Like a huge new employer or something.
Exactly. But the thing is, the spike isn't totally out of nowhere. It does reflect some really intense long-term appreciation in the area.
Okay, so pull the lens back for us.
If you look at that 340 number, it's a 36% increase over the price from just 3 months ago. And if you go back 2 years, it's a massive 64.29% increase.
Wow. So this market was already on fire. November just poured gasoline on it.
That's a good way to put it. Now, the key to understanding this is to compare that spike to the stabilizers. The median list price and the median estimated value.
The numbers that are a little less dramatic.
A lot less dramatic. The median list price in November was $292,500.
So sellers are asking for almost $50,000 less than what the median home actually closed for.
Right. Which, again, suggests those November closings were not your typical homes. And just as important, the list price is only up 1.04% month over month.
So that's a steady, normal rise. Sellers aren't all suddenly listing their homes for $340,000.
Not at all. And the real voice of reason in all this is the median estimated property value. It's sitting at $256,300.
And that estimated value, that's the number that filters out all the noise, right? It looks at the fundamentals.
It does. It looks at square footage, location, long-term comps. And it tells us the growth here is robust, but it's not volatile.
What are the long-term numbers on that?
The estimated value is up 7.7% over the last year and a really solid 23.58% over the last 3 years. This is healthy, predictable appreciation.
Okay, so let's put this whole puzzle together. We've got super low inventory and high buyer pressure.
Right. 3 months inventory, 99.2% sold to list.
But we have slow transaction speed, 50 days on market, and then this huge price paradox.
A healthy, slowly rising estimated value of around $256, a moderately rising list price of $292, and then this monster outlier sold price of $340.
So the verdict?
The verdict is that November's $340,000 number was almost certainly an anomaly. It was driven by a handful of high-end closings all hitting at once.
Maybe some new construction or a backlog of luxury homes finally closing.
Could be. The long-term trend is solid, but that 340 number should be treated like a rogue wave, not the new sea level.
To really prove that, we have to look inside the box, right? See exactly which homes are selling. Let's break down the actual inventory.
Yeah, let's do it. So looking at the new listings from the last 3 months, the first thing that just jumps out is the incredible range of properties in Farmington.
This is not a cookie-cutter market.
Not at all. We saw everything from, a classic starter home, a little 2-bed, 1-bath place from 1962, listed for just $130,000.
All the way up to what?
All the way up to a luxury estate. A massive 7-bed, 7-bath home on an acre, listed for $895,000.
That is a swing of over $750,000 in the available inventory. It's huge.
And the speed for those new listings was interesting. The median list price was $314,900, but their median time on market was 28 days.
So much faster than that 50-day average we saw for the whole market.
Way faster. It suggests that if you price it right, even the expensive stuff is moving pretty quickly.
Okay, so what's actually going under contract and closing? Let's look at the pending and closed sales.
The speed difference here is really stark. On the pending side, we saw some truly frantic activity. One property, a 2-bed, 1-bath, went pending in just 4 days.
4 days, that's the bidding war environment we were talking about.
That's it right there. But then you have the other side of the coin, the properties that prove why that 50-day average exists.
Like what?
We saw a new construction home, a 4-bed, 2-bath, that took 241 days to go pending.
241, that's 8 months.
8 months. So if you're in this market, you need to know you could sell in a week, or you could be waiting the better part of a year.
And the closed sales show the same thing?
Same exact pattern.
Yep.
The fastest close we tracked was a 3-bed, 2-bath that sold for $294,000 after just 5 days.
Clearly priced perfectly.
Nailed it. But contrast that with another large home that took 140 days, that's almost 5 months, to close for $410,000.
So that crazy 340 median in November doesn't mean every single house is just flying off the shelf.
No, it all comes down to pricing and what segment of the market you're in. And it wasn't just single-family homes either. We saw a condo close for $200,000.
And how long did that take?
That one took 109 days. So the demand is there across the board, but patience is still the virtue.
Okay, finally, let's touch on the parts of the market that can signal, hidden stress or opportunity, distressed homes and rentals.
We tracked 4 distressed properties. All of them were in the notice of foreclosure sale category.
It's not a huge wave of foreclosures, but they're there.
They're there. And it's a mix of really old homes and some surprisingly new ones, like one built in 2018.
And for an investor, what's the opportunity there?
It's pretty significant. The median estimated value of those distressed homes is only $206,000.
Which is way, way below that 340 median sold price we've been talking about.
Exactly. It's a clear opportunity for someone with cash who is willing to take on the risk of a foreclosure. It just reinforces that market dichotomy.
The main market is red hot, but there are still these little pockets of undervalued inventory.
And on the rental side, the market is incredibly sparse. We only tracked one property for lease in the last 3 months.
Just one. What does that tell you?
It tells me that if you want to move to Farmington, you are almost certainly buying. The rental market just isn't an option for most people.
So all that demand gets funneled directly into the for sale market, which just adds more pressure.
And drives that sold-to-list price ratio up even higher.
Okay, let's wrap this up. Let's synthesize this whole picture for Farmington. We kind of solved the mystery, but the market is still incredibly complex.
I'd say so. Fundamentally, it's a low-inventory, high-demand seller's market. The 2.33 months of inventory and then 99.2% sold to list, that confirms it.
But all that pressure is being hidden, in a way, by that strange counter trend.
The 50 median days in RPR, it suggests homes are sitting longer, and that's probably due to sellers overpricing their homes based on the hype.
And we're attributing that massive 47% jump in the median sold price to 340 to a one-time concentration of high-value closings.
Right. The long-term appreciation is real and solid, but that $340,000 figure is probably just noise, not the new trend.
So the market is hot, it's diverse, and it's volatile month to month.
And that leads to a really critical final thought for anyone trying to navigate this. You have a choice. You can anchor yourself to the high but volatile median sold price of $340.
Or you can anchor to the lower but much more stable median estimated value of $256. And with the median list price sitting around $292, sellers and buyers have a tough question to answer.
How much is that November spike really going to affect behavior in December?
If sellers all start listing their homes based on that 340 number, that 50 median days in RPR could get even longer, couldn't it?
Absolutely. So the real question to think about is this. How quickly will the market self-correct and pull that sold price back down toward the established trend lines? That's the challenge when you're planning your next move in Farmington.